Welcome to Straight Talk and Retirement, your no-hype source for financial advice in making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Aaron Lapidus.
Hello, St. Louis, and welcome to Straight Talk on Retirement, your live and local St. Louis's favorite financial call-in show. I'm Aaron Lapidus, president of JBL Financial Services, financial planner and wealth manager, and I'm here and joined every single week by my dad, Jeff Lapidus, wealth manager and retirement coach, and my husband, Robert Markham, our life insurance and fixed annuity sales specialist.
Good morning.
Good morning, babe.
Good morning. We help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan with several goals in mind.
First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate.
Second is to provide an income stream they can rely on so they can do all the things they want in retirement.
And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to couple with their Medicare coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches, or charities, whoever it might be, without Uncle Sam of the tax courts taking a big bite out of their money. And as their wealth managers, Aaron, Rob, and I watch their money every single day to make sure they're staying on track. And that's why they call us the retirement coaches. Gang, again, good morning, and good morning to everybody out in Radio Land. Thanks so much for taking 2 hours, hopefully 2 hours, with us this morning.
That's right, especially on this very happy holiday weekend.
Absolutely. It's the middle of Passover and getting ready to be Easter, right?
That's right.
Well, we want to wish everybody a very happy family holiday season, certainly. And as a reminder, all of our clients are folks like you. They're our listeners. They're 55 and older. They would like to retire, or they are already retired. And as Aaron mentioned, our goal is to create a game plan for them so they can have a fun and financially secure retirement. And for just also as a reminder, there are lots of ways that you can keep in touch with us during the week.
That's right. Log on to our website, jblfinancial.com. You can find a lot of helpful tips and tricks on our website. We have not only videos, we've got a blog, but we also have a monthly newsletter. We call it the Coach's Corner. If you click the sign up button that appears on almost every page of the site, Rob will ensure that on the first of every month, you receive your Coach's Corner newsletter by email, or you're also welcome to take a look at those that we have logged on the website. If you have a question or if you'd like to arrange a coaching session, financial, Medicare, or both, you can click on the Contact Us button that's located in the top right-hand corner of the website. So, Rob, why don't you tell us a little bit about our brand new April newsletter?
I got some great articles in the April 2026 newsletter for your perusal. The first one being, what do Americans do with their tax refunds? 100 million taxpayers will receive refunds. The average refund is a little over $3,000. What are they going to do with all that money? Well, we got an interesting infographic that lays out exactly what they're going to do, and I'm just going to read a couple of them. 31% plan on saving that tax return. Only 3% plan on putting it towards a major purchase, i.e. car, refrigerator, so on and so forth.
I think that one seems like This one, it seems like a difficult pull, because what if you're saving towards a large purchase? You know, I put it in the savings. But what I was noticing most interestingly about this infographic is that 31% of people say they're going to put it into their savings, which is fantastic. 21% say that they're going to be paying down debt. And I just found that percentage interesting because we've heard, reports about increased expenses, increased debt that Americans are taking on. And so for 100 million taxpayers to be receiving a the range of a relatively substantial refund to not need to use it to pay down debt is hopefully a positive sign.
I did that one year. I used my tax return to buy the car that we're currently driving.
Excellent planning.
Didn't pay all of it, but
I had a dream about a tax refund.
That's all that's going to be is a dream.
Right.
And our next article, Be Storm Smart, How to Prepare for Extreme Weather. Almost a third of U.S. homes are exposed to at least one type of extreme weather risk. Extreme weather can strike unexpectedly. I mean, 1 minute it can be, remember we were driving home from the gym last year?
Yeah, the tornadoes.
Yes, and we were like, wow, I guess we're not going for our afternoon walk, and then before you know it.
Right.
Yeah. You can't control the forecast, but what you can control is how you prepare for it. So that starts with having a plan, knowing evacuation routes, having several days of food, non-perishable canned goods, batteries, water, flashlights, candles, and, of course, a first aid kit all come in handy, especially as we go into hurricane season.
And I also think this is a great article because it's laying out some of the financial things that you can do to protect your home from inclement weather or out of the ordinary weather. And although we've seen that many of the insurance companies have stepped up to the plate for repairs on, windows, roofs, maybe they don't cover it all, and maybe they won't always cover it all. So it is important to have that rainy day fund, so to speak, so things don't upset your apple cart just because you're missing a shingle on the roof.
Absolutely. And even if something doesn't go wrong with the house, what if just a tree falls on the property?
It's a great point.
And tree removal is not cheap. So having that emergency fund to deal with these eventualities as they occur, it can never be wrong. Our next article, Are Stocks Expensive? Look at the P/E ratios. Stocks are expensive. Stocks are overvalued, undervalued. What is the reference point for these opinions? One of the most common ways to measure the value of a stock is to look at its P/E ratio. For example, a P/E ratio of 20 means that investors are willing to pay $20 for every $1 of earnings. By this standard, a stock with a P/E of 25 would be considered more expensive regardless of the share price.
And just for everyone, P is a price-to-earnings ratio.
It is.
Okay.
A higher price-to-earnings ratio also indicates that investors are expecting higher growth from that particular company. So if you see a company with a rather large P/E ratio, it almost always means that investors are expecting high growth from those companies. But before we make any wholesale changes to our portfolios based on P/E ratios, we want to sit down with a financial investor and make sure that any changes you make with respect to your portfolio falls in line with your risk tolerances, your financial goals, and your time horizon. And our last article, How AI is Helping Modernize the IRS. After years of slow audits, taxpayer frustration, and endless paperwork, the IRS is beginning to leverage artificial intelligence to help fraud detection and to provide better taxpayer services. And they're hoping that this will result in shorter wait times, free up agents to focus on complex issues requiring human intervention. And these efforts to integrate AI will continue to move forward. And the IRS hopes that the progress they make will continue as they further adopt this new technology. And that is your April 2026 newsletter in a nutshell.
Thank you. You can find it on our website, jblfinancial.com, or you can email Rob at robert@jblfinancial.com, and he'll be sure to get you on the newsletter list if you would like to join the thousands of people that receive it once a month from our office.
And just as a reminder, I keep the last almost 2 years on there, so if you want to knock yourself out reading all the content we have, you're free to do so.
Excellent.
It's great. I know that many of our clients do forward these newsletters to their friends, also to family members, typically younger ones.
Right, because as you can see, even from our articles in April, this is not sometimes we are focused on retirement. Do you think that this is a great multi-generational newsletter in that many of the tips in here or the things that we point out span multiple generations, especially when we're looking at things like being prepared for extreme weather, things like PE ratios that we hear on a regular basis. All of those things pertain to investors of all ages.
Yes, and as a reminder, we are live and local, so our phone lines are open. We'd love to hear from you, 314-931-5877 or 84126 from the KTRS text line. And as I've said for many years, we always have a lot of things on our mind. What's more important is what's on yours. So again, give us a call. We'd love to hear from you, either in person, 314-931-5877, or by text, 84126. Great. So I was going to say, while we're waiting for the phone lines.
That's right.
And the text lines to open up, why don't we start off with a segment that we haven't done recently, our Rock Stars of the Week.
Ah, yes.
A fan favorite.
Let's do it.
Well, great. So we visited with Joe and Sally, who happen to live in St. Charles. Joe's 66. He is a sales executive at a very large private company here in town. Sally is 64, just a couple of years younger, and she was a computer analyst at a public company, one of the very few, that are still located here in St. Louis. Their goal is to retire later this year. And they haven't really decided whether it's going to be at the end of the summer or at the end of the fall, etc. But, the big question, just like everybody else has that comes in, is can I do it? Can we do this? Can we do it together? Do we have to do it separately? Can we do it all at one time? So let's just talk a little bit about their situation.
Absolutely. Neither of their employers offer pension plans, but they are power savers. They've managed to accumulate $2.6 million in pre-tax 401ks, $90,000 in Roth 401ks, and $160,000 in other savings. They have no mortgage debt, no significant credit card debt either, no student debt. They're debt-free.
Oh, my God.
Woohoo. It's pretty awesome.
Well, it's great.
Gosh.
Well, and what's kind of cool is that, it gives us some hints. Not that they've accumulated a fair amount of capital, which is great.
That's a big hint.
But also, they're not late. They're not basically stuck with a lot of debt obligations. We don't have a lot of outflows that are going on. Their primary mortgage is taken care of. They didn't talk about having a home equity line of credit, which is fine. So we're really looking at where's their income going to come from. Certainly, Social Security benefits are something that will be available to them. They neither have reached normal retirement age, and that was something where they were thinking, hey, as a secondary question, can we wait? Should we wait? Etc.
Okay.
And then finally, we do have other things that we might like to do, just like everybody.
Travel, those kind of things.
Travel, do upgrades on our home. Maybe we're going to have another car in the near future. So let's talk a little bit about and go into detail here about what their cash flow needs are.
Sure.
And whether they really have enough capital and cash flow to meet those obligations. And truly, we think maybe they have the potential to be rock stars.
Absolutely, and their spending per month is about $8,000 a month, and we know we have to add taxes back into that, so that brings us to a monthly goal of $9,600. Now, when we subtract out the Social Security benefits at full retirement age, that's about $6,000 a month for both of them. So
both combined, right?
Exactly. So a net needed monthly income of $4,600 a month annualized. That's $55,200.
All right, so they need about $8,000. We have to increase that for taxes, and when we take out their Social Security benefits at full normal retirement age, rather, we're only left with a deficit of about $4,600 a month, which means that if we have a lump sum of capital and we want to live off the interest and the earnings of it, we don't want to deplete the original invested capital. We only want to pull about 4% per year. So that means in order to pull $55,200 per year, we need about $1.3 million of capital.
So let's step back just for a second. $8,000 per month. Mm-hmm. Where do we get that number? Well, we're always asking, we always come at it in one of two ways. We have some folks that come in and they've got nice Excel spreadsheets, or they've taken a piece of paper and they've written down, hey, this is how much each thing is, what their costs really are running monthly. And We ask them if it includes entertainment and things like that.
Food,
etc. Right.
Sure.
Well,
many people
manicure,
think
pedicures, all that stuff, right?
Right. We send out a financial questionnaire prior to meeting with prospective clients, and it asks what monthly expenses are. And I think a lot of people interpret that as bills. Like, this is my mortgage, this is the utilities. But when we say monthly expenses, we mean just what does it take to live the life that you are currently living. That includes food, fun, entertainment, travel, trips to Starbucks, all that kind of stuff.
And a lot of folks say we don't really know.
Sure.
So
what happens to the people that don't really know?
So we come away. Then we come in for the other side, which is how much money is being deposited net after your withholding taxes, after your 401k contributions, etc., each month in your bank account.
So literally, what is that deposit from your employer or from yourself if you're self-employed?
Now, in this particular case, Joe and Sally told us that their deposit net each month was running about $10,000, and we asked them, well, are you consuming all of it? Is your savings at the end of the year? Because they mentioned they've got about $160,000 of other savings.
So, how did you get that?
Right? Is it growing? They go, yeah. We put aside pretty much $2,000 per month, and that isn't for consumption.
Meaning they're not saving for something specific, like we were joking a little bit with the newsletter, going to take the tax return, put it in savings, but is it put in savings because you have a planned expense for later? If that's the case, we want to reincorporate those dollars back into your monthly income.
And in their particular case, we did because we know that they were putting aside money each month to pay real estate taxes.
Okay.
Because they didn't have a mortgage. So they weren't escrowing those taxes anymore. So when we came out with the real net number, it came out to be $8,000.
So that means that's something that if you are considering at home, you're listening and you're thinking about how much do I spend every month, there are a couple of easy ways to do it. Either if you are someone that's already generated a spreadsheet that's all the way down to my haircut, this is how much everything costs, you probably have an excellent handle on your expenses. If you're someone, and this is probably the majority of people, at least I know I even operate this way, money comes in.
Money goes out.
Right. Money comes in because you already pre-saved. You had money going to your retirement accounts. Maybe you even have an auto deduction from somewhere that's, taken money into a savings account elsewhere. You put money in the 401k, you get a net deposit. Well, I just spend that. As long as the bank account's not negative, I know I can freely spend what's coming in, what's going out. So if I were coming in to sit down with us, we would just take a look at what is our net income coming in, and that would lead us to say, all right, that's what we want to hit on a monthly basis to maintain exactly what you're doing. You don't have to worry about, I had an extra coffee at Starbucks this month, because although all
those things are incorporated in.
Right, and it evens out because people get a little intimidated when we ask what their monthly expenses are because, well, we don't do the same things every month. Things cost different amounts. Absolutely. However, if you are living within your means, you've probably recognized sometimes the checking account is a little higher because you didn't spend as much. Sometimes it's a little lower because you spent a little more, but it all evens out over the course of the year. We're trying to replicate that for you when we get to retirement.
Just working the equation backwards, like I don't have the spreadsheet, but I know what's deposited in my account every month, and I know I'm usually, I have a couple $100 left over at the end of the month that equals, X amount at the end of the year. Well, yeah, that's a good way of figuring it out.
Sure.
If you don't have the...
It also can build in a very nice buffer for people because if you're concerned my spreadsheet doesn't cover every single thing that I do.
And how could it?
If we know that what you're bringing in does not exceed what's going out, if we meet what's coming in, then you will feel just the relief of those extra 40 hours of work that aren't in your schedule anymore, but you'll have the same amount in your bank account every month.
It's interesting also because we don't ask folks to do this exercise because we care what they're spending money on, because we don't. Your life is your life. If you want to buy, if you're a person that collects wine, great. If you're somebody who collects cars, great. If you're somebody who collects, or however
or
you're
you want to
spending
dedicate your excess to travel, there's no
or to the kids or grandkids. That isn't our function is simple. It's just to duplicate the income's flow so that you have the same income that you had after the time that you're spending the same amount pre-retirement as post-retirement. And there are some folks that look at their numbers and they go, we could cut back on this, we could cut back on that, and we chuckle and
or we say those are the nice thing here is let's let's run the numbers without you having to make any changes and see where we end up. If you make the decision that you'd like to change something about how you are spending money, that'll be your choice. And if we find that as we check in with you on a regular basis that you are now starting to accumulate money in that savings, maybe we reduce what we're sending every month.
You know, I think what's interesting is that it really gets, once we've done, and again, this seems like it isn't, look, it's not simple. But for us it is. Okay? Once we've gone through this math problem, can I afford to retire becomes very clear.
Right. Either we have enough capital or we do not.
Or we don't. And we can then go back and say, okay, based upon our current 401k spending or investing that we're doing and other investing, you know, if we assume a low reasonable rate of return, how long will it take us to get there? For some folks, that's when the clock starts. If they really aren't ready, it doesn't. But I would tell you that I think it's fair, and you'll tell me if you don't disagree, because you're seeing everybody comes in now. You visit with them first. 90+% of the people that come to see us, they're in a position they can retire. We don't send them back and go, you have to go, come back in 3 years and talk to me. We're obviously helping them along the way, but the bottom line is it isn't that they can't or that they're not able to reach their goal. They intuitively kind of feel like, hey, or they've listened to the show long enough that they've done the math problem kind of in their mind and they're coming in for confirmation.
That is true. And the other thing that I have noticed is that we have quite a few people coming in hoping that they have enough to retire, but concerned because they're consuming the same literature that many people are, which is
you need 8 million.
Exactly. We have an esoteric number that has been generalized not only across the spectrum for all ages at retirement, and we know that that number is a moving target. People tend to start skewing younger now in terms of retirement, and that creates new income needs and restrictions on cash flow that aren't incorporated into that 1 million plus number. Maybe it's 2 plus now with inflation. It also doesn't incorporate cost of living differences across the country, all these different things. So they come in concerned,
or health concerns,
or health cost and concerns. So they come in concerned, like, I don't have this number. Do I have enough? And the great thing is we are able to, in relatively short order, just like we have been with Joe and Sally in this example, is, like you said, Dad, the numbers become very clear. Now, getting us to that point, or some of the other questions that we'll get to with Joe and Sally, where does the cash, we know you have the capital to do it. Where does the cash flow from that capital come from? What accounts? When do we turn on Social Security? All these pieces, those are questions that we're here to not only help answer but help execute for you. But I have found it interesting that we have seen quite a few people that are in excellent positions and not having realized it because they're still working towards a number that is not their own. So if I know all of our listeners have had our formula for quite some time to be able to determine what is your personal number. So if you're following along with us, this will give you the opportunity to find out what's the personal number that you need to work towards. Or we often talk about maybe if we have a long enough time, a long enough runway, as opposed to trying to save more to get to that number, can we reduce expenses somewhere else? Now, Joe and Sally, in this particular case, we basically recognize that $8,000 a month income need is lifestyle. We don't have any debt service obligations to meet. There's no mortgage, there's no credit card debt, there are no student loans, no home equity line. So we're not looking to liquidate anything here, but if you're in a position where some of your debt service is what's holding us back from retirement, it may be a easier path to liquidate the debt versus trying to save more to be able to support the debt.
Yep. Short-term obligations that can, cloud up your glide path to retirement. We can sunset those, or we can put a game plan together so you can sunset those.
And that can really, again, what's interesting is, hopefully folks are picking this up. We're trying to get this across to you. The math problem doesn't change.
No.
Everybody's inputs are a little bit different.
Sure.
Some people have large amounts of outflows for whatever reason it might be, whether it's mortgage or family obligations. Others don't. It's all about replacing income. That's what retirement planning is about, replacing your income, having sufficient capital to draw off a prudent rate of interest. We use 4%. That's a 4% rule. It's alive, it's willing, it works. And then what's really fun is, for us, when we're visiting with our clients every 6 months or every 4 months by phone, however they want to do that with us, every time we go back to withdrawal rates, where are you and compared to the 4%? As their capital grows, the withdrawal percentage decreases, which is great because they're entering more of what we like to call the safety zone. When we have times where the markets are a little unsteady, little pullbacks like we have now, doesn't change the math. The math continues to be the same. If we're within a prudent withdrawal situation, we don't have to change their outflow. We don't have to change what we're sending them to match it specifically.
Right, because the 4% withdrawal assumes that there will be negative markets.
Absolutely.
So, but that also assumes that in positive markets, we are not over-withdrawing to increase our 4%, or we're not increasing our 4% because our capital base has grown.
Right. So if you had a 10% year in the market, say, of growth, and you're sucking out 10%, you're not leaving yourself that wiggle room when the markets turn on you.
Exactly.
And it's never really a question about how much can I pull.
Sure.
Even though people intuitively think, well, how much can I pull? It's not how much can you pull, how much do I need to pull?
Right.
And if I get into a situation where I have to withdraw more, whether it's from either pre-tax savings like your IRA or after-tax saving like a TOD or trust, is that going to tip the apple cart? And in most cases, I will tell you that the answer is usually no. It usually is no, because what's happened is that they're following this prudent withdrawal rate. Accounts are growing, as they will. And what then happens is that I like to say that we're banking the gains. We're banking them to be consumed later, or frankly, to be passed on to the people you love later.
And I think that actually is a great segue into, I want to get to this one quick text question before we get to our break.
And our first texter of the day writes, in which ways does JBL Financial respond to the volatility of the markets to help reduce losses of their portfolio?
So the reason that I thought this was what you just said, Dad, was an excellent segue is that when we talk about our investing philosophy and that we lean towards asset appreciation in an attempt to skim growth over time. So when we see the portfolio appreciate, we are skimming some of the growth in order to create monthly income for our clients. To that end, when the markets become volatile, instead of keeping those gains fully, what we would call fully invested, meaning we've got maybe 1 to 2 months worth of monthly distributions in cash in our client accounts, what we do is we say, let's increase that cash component as our first defense against market volatility, because although that is not going to change the underlying investments and the fluctuations that they will have with the market, what it does do, it gives us the opportunity to delay making any sales in the portfolio that may create additional negative returns. So selling in a negative market is a double negative, whereas holding until we see the market recover is just volatility, right? We've got short-term paper losses versus having realized them. So what we did a while ago is when we saw the volatility increasing, we said now is the time. We're still close to the very top of the S&P 500. Let's generate 6 to 8 months worth of cash for our clients. So that way they are going to truly live off of the gains of last year in their portfolios and allow the rest of the portfolio to essentially rehabilitate. Many people are looking at the extreme swings in the market and maybe seeing a slightly more dramatic picture than what's currently happening across the market, which is we are off the highs. I believe the S&P is down about 7. They're not even 30. No. After the rally, before our rally of this week, we were down just shy of 10%. So I think we're in the somewhere in the 5 to 7 range right now off of our highs. most individual. This works in two ways, right? When we're looking at a rising market, people look at their portfolio and say the S&P is up X. How come I am not also up that much? Well, the reason you're not is because hopefully you're not 100% invested in only U.S. equities on the S&P 500, number one.
And the large ones.
Right. And number two, you have fees. The S&P is pure of fees. Everyone that invests has fees. It's either ticket charges, it's 12B1 fees, you have additional fees in your portfolio that the indexes do not have. So most people do not rise 100% with the market, but also most people do not fall 100% with the market because, again, you're not fully invested in just one index. Hopefully you're broadly diversified, and it's not all in equities. You have some fixed income available that will help balance the portfolio for you. So I bet if you took a look at where you are currently sitting, depending upon your mix, you're probably not tracking the market 100%, nor are our client portfolios tracking the market 100%. They're not designed to do that. We also don't like to make changes during volatility. The time to make changes is when we are doing our portfolio rebalancing as well as our portfolio construction reviews, determining are we happy with the mix that we've created for the next 6 to 12 months. Just as, when you're in a high stretch situation, you don't want to be making decisions. You don't want to make reactive decisions. We pre-planned for the volatility, just like our planning paradigm plans for volatility. That's why we want to only pull 4% of our portfolios on an annual basis. Our portfolio construction also incorporates that there is volatility. Being a long-term investor does not mean that you are going to sidestep volatility. What it means is you have the time and you have built a plan that will allow you to live through the volatility, because that, at the end of the day, is the price that we're going to pay for our possibility of higher returns in the future.
Yeah, honey, the only thing I would add in sort of summing this up is generally there's two ways that we as advisors deal with our clients' assets in terms of their investing. One is strategically. And strategically means that we're creating a portfolio mix of stocks, bonds, and cash that meet your risk tolerance. And that's really our base. Second level is tactical. Okay, are we adding additional weightings in specific industries, in specific areas?
Like international versus domestic.
Exactly,
tech
large cap,
versus
small cap.
banks.
And then and then we can even talk about even going further, which is, are we adding more techie? Are we Aaron and I, Rob, we're a little techie. Just to let you know, we kind of lean towards tech. Tech has been growth. It's really shown the most growth over the last 10 years.
Also, tech doesn't have to be the Mag 7.
Right.
So we don't. No one ever has to have all their eggs in one basket just to see returns in the market.
And they're not. But so we use a mixture of strategic investing and tactical investing. And so, as Aaron was mentioning, that decision to increase the cash part of our client's mix is a strategic decision.
Right.
Where do we go from there? Our last month's newsletter, Rob talked about how international investing, for the first time in maybe 7 or 8 years, actually outdid U.S. investing in U.S. markets. How do we deal with emerging markets? I mean, these are all questions as your investment advisors that we deal with. And fortunately for you, we get inundated every day with opinions. From the experts.
From market research from experts.
From every single company that we work with. And so our job is to filter through the noise, and to come to our conclusions, which I think, frankly, that we have and done that. And we think that a combination of strategic investing, which is mixed control, and then tactical investing, which is adding emphasis in certain areas at certain times,
and then overlaid with long-term planning.
Exactly. Is really, frankly, that's what you pay us for. And the fun part is, like with our Joe and Sally example, we sit down with folks, we find out about them and where they want to go. We're able to justify to them, or actually give them, if you want to call it, confirmation that, hey, you've been great savers. You'll be okay. And you have choices. As an example, one of the choices that Joe and Sally, we know that their thought was Joe 66, Sally 64. Do we wait until 67 to take our Social Security benefits, or should we take it today?
Mm-hmm.
There are a lot of, and for them, it really isn't a money issue because we know that they have enough capital based on a 4% prudent withdrawal to do what they want to. The question really becomes, okay, Joe, is there any tread left on the tires? Do you see yourself going back to work, earning money actively, so that you might be in a situation where we could deal with Social Security take back? Same thing as with Sally.
So before we get back to Joe and Sally, why don't we take our first break of this hour, and then we can do a little review of Joe and Sally because we've kind of gone a little astray, and talk a little bit more about that decision. Do we take Social Security or do we put that off?
So don't touch that dial. We'll be back with more Straight Talk on Retirement right after these brief messages.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
Mark Lawson here, owner of Black Fox Cooper. We're an Anderson certified contractor. That means every window we install meets Anderson's exacting standards for quality, performance, and durability, and our installation is guaranteed for 2 years, in addition to the 20-year warranty on the glass. With over 20 years experience knowing our customers, we install the optimal windows to keep your home comfortable, efficient year-round, and most projects are completed within a day or two with minimal disruption to your daily routine. Financing is available. Call 314-270-1484 for a free consultation and estimate, or online at blackfoxcooper.com.
The official birthplace of the toasted ravioli is
Mama's on the Hill.
And Mama's on the Hill serves the best in town. Mama's has been a mainstay on the Hill for decades and is still a family-run restaurant serving up great Italian food in a fun atmosphere. Open 7 days a week for lunch and dinner, and right in the heart of the Hill at Edwards and Bischoff. Delicious catering and party rooms too.
Mama's on the Hill.
Make reservations at 314-776-3100 and 24/7 at mamasonthehill.com.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
It's bracket season. Dogtown bracket, that is. And while the players take the court, the Dogtown pizzas hit the ovens.
Pepperoni versus sausage. Bacon versus veggie. And don't forget #1 overall seed.
Hot chicken. And with 13 different varieties, this will be the tastiest Final Four in league history. Celebrate tournament time with Dogtown Pizza and build your own bracket with 13 different varieties. Dogtown Pizza and dogtownpizza.com.
Now, back to Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Aaron Lapidus.
Welcome back to the show. We've got about 16 minutes or so left in hour number one. We were just flying.
Right, because we got a whole other break to take before we get to the end of the hour.
Which is great. So let's take a couple of text questions if we have them, and then we'll get back to Joe and Sally if we have time.
And this is pretty much related to what we were just talking about. Our next texter writes, how often do you sell stocks, funds, etc. to get gains? And is it considered rebalancing your portfolio? Should you take profits every year and then buy when the market is low, or is this considered timing the market? Is it better to just be a long-term investor at retirement, only selling when you need the money? Thank you. Really great question.
This is a great question. I would just start off with saying that we rebalance our portfolios on a quarterly basis. Automatically. And rebalancing means that you are attempting to regain the balance of your portfolio that was originally set. So let's just use an example. If you are 75% equities and 25% bonds and cash, by the time you got to December of last year, most likely your mix is no longer that 75-25 target because equities performed very well and the bonds stayed relatively stable. You have probably seen a drift of 75-25 to 78, maybe 80%. 82% equities, 18 to 20% bonds and cash. Taking from the equities and rebalancing back to that 75-25 would be considered a rebalance. Rebalancing can also be not maybe you've seen drift, but maybe you get to the end of the year and you see the same example. Tech outperformed value. Growth significantly outperformed value last year. We didn't start to see that rotation until the beginning of this year. Maybe that means we're pulling some from the growth side and moving it into the value side. So there are different ways to rebalance, but rebalancing means you're taking from one piece of the portfolio and adding it to another. You're not going into cash, unless cash is the part of the portfolio that needs to be rebalanced.
Well, or unless there's a specifically identified need for cash to be available at that particular time. And so what we're then doing is we're setting that cash aside, rebalancing the portfolio, and then using that money to deal with whatever additional client need was there.
Certainly. Then the next piece of the question is, should you take profits every year and then buy when the market is low? So a true rebalance, at least the way that we see it, is going to happen mechanically and at the same time, meaning as you're rebalancing on a quarterly, on a semi-annually or an annual basis, the money's going right back in. It's not based on market timing, meaning I'm waiting to rebalance when the market does X. It means systematically, based on time, I am consistently rebalancing the portfolio. If you are waiting for a specific event to occur, that could be considered market timing, and it can be a little precarious, right? Because you have to make the decision that the market is at a bottom or it's at a top in order for you to get reinvested. What we have noticed over long periods of time, and what the data shows, is that it's not about finding the bottoms in the market. It is about not missing the highs. So, for example, we can even look at this past week. We saw an 1,100-point rally on the Dow.
700 on the NASDAQ.
And sometimes that can be construed as we see the biggest rallies during the most volatile period. So that could lead us to believe that the volatility is not over. But missing that day is more significant than having lived through all of the volatility preceding it. So you can have significant, even missing 2 of the top days over your entire investing career can have, I think it's over a 10% impact on your overall returns. So that is why we often talk about time in the market is more valuable than attempting to time the market.
Yeah, I mean, when you think about this week was the first positive week.
In 5, I think, right?
6. We had 5 S&P. Negative weeks. I mean, let's put it this way. You certainly, regardless of your political leanings, you certainly can't do it based upon what the president says.
That is dangerous.
Well, it is. I mean, any president, usually when they get on TV, the markets are negative. But, hey, we may have an end to the war soon. Straight to Hormuz open. Okay, great. One day, what happens if they close down the next day? I mean, You can't time things. It doesn't make sense to time things. That isn't really how you grew your portfolio over a long period of time. Doing it systematically, having it done mechanically, takes the animal spirits out of it so that you can, frankly, take your emotions and use them towards things that you like to do.
That's right. I definitely agree with
Definitely do not want to be making wholesale changes to your portfolio based on the news cycle or,
any news cycle.
Right. Yes.
Completely agree. Let's take one more text question, and I think we'll take our second break of the hour.
Terrific.
Just mowing through things.
Yeah.
And our next texter writes, hey, good morning, everyone. Got a quick question. Don't know if I'm confused or not, but am I still allowed to add money to my 2025 Roth account?
As long as you have not filed your taxes for 2025 and you meet all of the criteria to contribute to a Roth, meaning your income is not above a threshold that would eliminate your ability to contribute to a Roth.
You haven't already met the limits.
Thank you. You haven't already met contribution limits, and you actually have earned income that would make it eligible for you to contribute to the Roth. As long as you have not filed your 2025 taxes yet, you are able to contribute for 2025. That's all the way up until April 15th or your filing date, whenever you electronically file or your accountant does it on your behalf.
Cool.
All right.
And with that, I think we'll take our second break of the hour, so don't touch that dial. We'll be back with our last 10 minutes of the first hour of Straight Talk on Retirement right after these messages.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
Game day comfort steps up to the plate Saturday, April 11th, when the Cardinals face the Boston Red Sox downtown. That night, fans can score a Cardinals dugout hoodie presented by Mercy, built for cool nights, late innings, and early season baseball. It's a classic, easy-to-wear layer you'll reach for all year long. Available in medium or extra large while supplies last. Don't miss this spring matchup. Get tickets and details at cardinals.com/promotions.
Every Sunday home game is a Kids Sunday at Busch Stadium. From Team Fredbird and games to a kid-friendly DJ, ice cream, and family-favorite activities. Sundays are built for young fans. Plus, select Sundays feature kids run the bases after the game. It's a day made for smiles, memories, and Cardinals baseball together. Make Sundays your family tradition at Busch Stadium. Tickets and details at cardinals.com/KidsSunday.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at aaron@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
You're selling your home, and I want to buy it. This is Mike Robinson with Robank Properties, and I am ready to pay top dollar for your home. No contingencies, no inspections, no monkey business. I buy your home no matter the condition or location, and you walk away with cash. Call me, Mike Robinson, at 314-283-0867, 314-283-0867, or at robankproperties.com. That's ROBANG properties.com.
Mike Lippert here for Lisi Lumber, a family-owned company that's been serving the area since 1872. You've heard McGraw mention our knowledgeable staff, excellent customer service, and the best of woods. We're now producing and delivering custom prefabricated trellises, pavilions, and pergolas. Union-made, union-delivered. Homeowners and do-it-yourselfers are going to love these. Got an idea? Send a sketch and some dimensions and we'll take care of the rest. For the best of woods and prefabricated outdoor dreams, call Lisi Lumber 234-0105 or LisiLumber.com.
Hey, Heidi Glaus here, asking you to join us weekly as we present the KTRS Book Club, presented by the St. Louis County Library for readers of every generation. Books transport us anywhere our imagination wants to go. They are absolutely magical. The KTRS Book Club will introduce you to local and national authors, events, and special programs presented by the St. Louis County Library every week from 3 to 6 right here on the Big 550 KTRS.
Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Erin Lapidus.
9:53 here on the Big 550. We've got about 6 minutes left in hour number one to answer your questions. Your phone calls, your text, 314-931-5877 or 84126 from the Heating Up text line.
And our next texter writes, I just found out that the charity to which I make a qualified charitable distribution went out of business late last year. I have not yet done my taxes. Any advice on what to do?
Yes. Hopefully you have to do nothing, because as long as you made the donation when the charitable organization was still in business, meaning they still had their tax-exempt status, you still get to take the deduction, or you still get to count it as a qualified charitable distribution, meaning it was just a non-taxable distribution out of your IRA account. Your custodian has the date of when that check was distributed. You just need to check when the date that the charity officially shut its doors, and not shut its doors like, sorry, we're out of business, but lost its 501c3 status, because that could actually extend the date out a little farther. Just like, you see companies that have going out of business sales, that doesn't mean that's the day the business went out of business. That means they're winding things down. Same thing with the charity. Just double check when they lost their 501c3 status versus when you made the donation. If it was your donation prior to the losing of the tax exemption, then your donation is still considered qualified.
And then you have the fun of finding somebody new to send money to.
That is right. And if you find that your donation went in after they lost their exemption, that just means that you should notify your tax preparer, accountant, or if you're doing that yourself, you're just going to have to take the taxes. You're going to have to just claim that one distribution as taxable. Hopefully, you probably won't be able to recover your funds, but just to be safe, you would want to mark that one as taxable.
Sounds good.
All right.
Do we want to save that one for...
Let's save that one for a moment because we've only got a few minutes left in this hour.
Well, that's fine. You want to go back to Joe and Sally?
Sure, let's take a few minutes on Joe and Sally.
We were talking about them. We found out they were rock stars. The cash flow that they needed was approximately $8,000 a month. With their Social Security benefits together, that was going to run about $6,000, so we knew we needed to fund approximately $4,600 per month. $1.35 million of assets is what they needed. They had $2.6 million. They're rock stars, but they did have some other needs, didn't they?
What if they delayed Social Security?
That was one of the questions that we had, and what's kind of nice for them is that they have options. Again, some of the key factors would be I think number one is health. Are they both healthy? Will they be around to collect their Social Security benefits? If you're not healthy, you probably should take. The second one would be, are you going to work between now and your normal retirement age?
The tread on the tires question. How much is left?
Exactly, and if they decide they do want to continue to work, electing Social Security benefits could create a take-back situation. Robert, I know you know the numbers.
The numbers for those married filing jointly, $65,160 the year you turn normal retirement age. Prior to that, they'll take back one for every two over $24,480.
So we know Sally's about 3 years away. So for the next 2 years, if she earned more than $22,000, or she planned to earn more than $22,000,
we say no, don't take it.
No, Nanette, don't do it. But Joe, and then the question is, what about you, Joe?
Right, because earned income is going to be tied to the individual, which means one spouse can take and the other can continue to work or go back to work or work part-time, whatever the case is. You're not going to impact each other's benefit by someone working, but you can impact your own benefit by earning income.
We also we didn't mention here is that, Sally, she had a fair amount of earned income.
Mm-hmm.
And so therefore we weren't even thinking about, hey, do we have to wait and take the spousal benefit because her benefit is less than half of what Joe's is going to be at normal retirement age.
We know she's taken her own benefit.
Exactly. So that wasn't a factor. So there are a bunch of other contributing factors that we have to add into this algebra problem. And the fun part is, truthfully, is having the privilege to do this with them.
That's right.
And we did this on our big 4x6 foot whiteboard. Then we began to go through the what if options with them. What if we take this? What if we take that? Then we also got into a question of, okay, we know, and they indicated to us that they really needed about another $100,000 or more to deal with some home repairs that they wanted to have, and also a new car purchase. Well, where's that going to come from?
Milk money?
I don't think so. I don't think I'd make taxable distributions to make that happen. They have a nice Roth IRA, or a 401k, which is going to become a Roth IRA, about $90,000. So maybe what we're looking at is putting some dollars aside for that. Maybe, Robert, you're right, we might increase the distributions from their IRA accounts.
Well, we can always play the tax brackets.
Right.
And I totally neglected their $160,000 in savings.
Right.
Right, and that's one of the questions we often have, which is, well, $160 in savings is fabulous. What's our safe number? How far do we draw that down before?
The vault.
Right. Where's the vault in
comfort
that 160? Level. So where's your comfort level so we don't create an uncomfortable situation for you in our planning? So if we know 100 is their comfort, we have 60 of excess to work with in terms of distributions. But as always, some of these things can be financed, and it doesn't have to be on the schedule that we take. We can create our own. Some of these things can't, home remodels usually can't be financed. So we want to look at what can we extend out, what will create the the best tax situation for us, and then we get to, as you say, Dad, plan it all out.
And it's easy to do. You just come to our offices, and give us a call, 314-863-0008. Don't touch that dial. We'll be back for hour number 2 after just...
Welcome to Straight Talk and Retirement, your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Aaron Lapidus.
Welcome back, everyone, to hour number 2 of Straight Talk on Retirement. As always, we're going to kick our first hour off with our Smart Choices About Your Healthcare segment.
Because you care, we talk Medicare.
But if you have questions, our phone lines are always open, 314-931-5877, or send us a text, 84126 on the text line. It can be about health insurance, or it can be about anything financially related. We'll get to it after our segment, just like we are going to return to 2 very excellent text questions that we received during the end of the last hour in the break, but we'll get to those after this.
Absolutely, and we received a call from a listener of the show past Thursday, and he asked, is it too late to change my plan? Did I mess up? Did I wait too long? Am I now stuck with my plan? He said he had planned on contacting us before the end of the month, but back in February when we got hit with that snowstorm, he never got around to it, and he said he'd heard some things about his plan had changed, so he wanted to make sure he was still in the best plan. When he finally got he said what finally got him to call was he went to use his plan and the over-the-counter benefit, and his U-card did not work. Oh, God, that stinks. Get up there with all your product, and now it's like, nope, can't use it. So here we are, April 2nd, and Don wants to switch plans to a plan that has a over-the-counter without compromising his other health benefits. Don doesn't take any prescription medications, but he would like to use that over-the-counter benefit every month on supplements, vitamins, allergy meds, etc. And we asked how much he spent out of pocket, and he said about $30 a month, sometimes $20, so anywhere from about $200 to $300 a year. And he would spend a little bit more if he had that U-card, but we thought, well, that's perfect because we've got several
Why
plans.
does it matter how much he spent out of pocket so far this year?
On his supplements?
Just on the plan in general?
Because if he switches plans, those costs will not carry over to the new plan. Any money you spent on a plan for the first 3 months of the year, if you were to switch, those costs unfortunately do not carry over. So your max out of pocket will not carry over and not be affected by that.
Got ya.
So you'll be starting effect from new.
Right, so that would be some additional expenses. So we do want to incorporate that if people are still thinking about making switches.
All right, anytime you switch from plan, especially in the beginning part of the year or any part of the year, none of those benefits carry over, and any money you spent in that plan is a sunken cost, if you will, because you're going to get a new max out of pocket with your new plan, and any money spent at that point will go towards that new max out of pocket.
Well, open enrollment's over. It ended on March 31st. So how is Don, who was the listener that gave us a call, how does he have the opportunity to make a switch?
Because his zip code is eligible for a special enrollment period due to a weather-related event that we experienced. So that is the way he is able to switch plans, even though we are out of open enrollment.
Okay.
And since Don did not make any changes during open enrollment from his time of January to March 31st, he does qualify. His zip code qualifies for a special enrollment opportunities to switch plans through the end of June. So he is not locked into his plan through the end of the year. This is a special enrollment period to switch from one Advantage plan to another Advantage plan using that special enrollment period.
So if you did make a switch, though, from January to March, you are not eligible to make another switch. Is that correct?
The rules of the FEMA special enrollment state that you must not have made any changes to your plan whatsoever between January 1st and March 31st. If you did make any changes during that time, if you did not make any changes during that time, you qualify for a guaranteed special enrollment to use the FEMA rule for that special enrollment period. In Don's case, since he missed coming into the office in February due to the snowstorm, and it's now past March 31st, he qualifies to use the FEMA enrollment. And we were able to switch him to a plan that offered an over-the-counter of $90 per quarter for an effective date of May 1st. Now, he won't be able to backdate and use the first quarter's for the money he already spent on his over-the-counter benefit, but moving forward, he will have $90 per quarter.
That's great.
And if you missed the open enrollment from January through March and you still have questions about your plan's benefit, it's not too late. It may not be too late to make a change if you qualify for a special enrollment period. If your zip code is one of those that was affected and that they are allowing to make a switch, you are able to do so using that period.
That's right. So maybe it makes sense if you're someone that didn't take a look during annual enrollment and you didn't take a look from January 1st to March 31st, or maybe you did and didn't make a decision, you still potentially have an opportunity depending upon your zip code. And these FEMA enrollment periods actually roll throughout the year, which means if something else happens, of course, we hope it does not, we may end up with additional special election periods that will give people opportunities to make switches. However, they are zip code based. It does not mean that you had to be personally impacted in most cases, but it does mean that you need to qualify based on where you live.
Looks like we have a
caller?
We do. Good morning, Randy.
Hey, how you doing?
Good morning. You have a question for us?
Yeah, we're buying a place in Florida, and we've checked on getting a loan possibly or doing the 401, pulling it out of the 401. I'm 66 years old. Place is only $95,000. So we start thinking about taking out of our Roth IRA. I just wanted to get some insight on that.
The whole thing or just the down payment?
Probably the whole thing should just be done with.
Got you. And so you said that, so you have a Roth IRA or is it a Roth 401k?
I got a Roth IRA and a Roth 401k also.
Oh, gotcha. And are you currently retired or are you still working?
Retired.
Got you. And you just decided you didn't want to take a loan out for the $95,000. You just want to pay it off in cash?
Yeah.
How much?
We checked into the home equity loans, and they're just kind of ridiculous.
How much do you have in the Roth?
About 125.
All right, Dad. So we've got our caller, Randy, asked. He's got about a $95,000 purchase of a home. He's got 401k assets, but also a Roth of about $125,000. Does it make sense just to pull that out of the Roth because he doesn't want to do home equity and doesn't want to take a loan?
Right.
Randy, do you have other non-retirement assets outside of your 401k and Roth?
Like savings, investable assets?
No, just what we have in our savings.
Okay.
I get disability for the military, and then my Social Security.
Okay. So, do you have an IRA or a 403?
Yeah, he does have a 401k.
Okay. How much is in that?
That is total with the Roth is like 1.1.
And so that means it's about $1 million in pre-tax and about $125,000 in Roth.
Okay. So,
yes.
I was going to say, do you have any purpose in terms of passing this Roth on to your heirs, et cetera? Is that something that's important to you, or it's really just you did it because it's after tax, it's tax-free saving?
Right. We've thought about it, and we're just not really secure yet. Most of them are doing really well.
Okay, well, here's, the problem is once you withdraw from your Roth, it's gone. And certainly that's a source of, non-taxable income, and I would say that would definitely be something you want to consider. But I also take a look at where are you in regard to pulling money from your IRA. Would pulling from money from your IRA take you into a different marginal tax bracket? So you might want to consider maybe a combination of two. Maybe you're pulling a little bit. Maybe you're pulling a little bit from your IRA, paying the tax on that, and then basically complementing that with your Roth.
Yeah, because Randy, how old is your wife?
She's 66.
Oh,
Also.
fabulous. So that means this is actually a great this is a great year for you, because if you can keep your income below $150,000, then you're going to get that extra $12,000 deduction.
The Trump bump, as we call it.
Right. So if you can thread that needle a little bit, taking a look at your current tax bracket, how much can we pull out of the traditional IRA, keep us in the same bracket, maybe also keeping us below that 150 number, you might be able to preserve more of the Roth. So with 125 in the Roth, that would only leave you about 30,000 if you pulled the full 95 from it. So you might consider saying, like, how much can we get out of that traditional IRA at a reasonable tax rate, and then pull the balance from the Roth.
Yeah.
Okay, and then and just stay under 150.
Yes.
That's right. You want to stay, so there's a couple of thresholds here. 150, I would say, is the highest threshold, because that's going to keep that $12,000 deduction in place for you. But the first threshold for married filing jointly, I believe, is right at about $90,000 this year because of adjustments for inflation in terms of the 12% tax bracket. So you'd want to try to thread the needle between those two numbers, staying below that 150.
Randy, how old are you? Do we know
He
that?
said 66.
Oh, okay.
66.
Okay, so that's cool. So
Yeah.
there's no RMD eligibility here.
We have everything paid off. I mean,
yeah. So again, I think if you want to do a dance with your tax brackets a little bit, I would look at doing some IRA distribution, but otherwise, that's what Roth is there for. And frankly, that's what most of our clients use their Roths for these large purchases, extraordinary numbers.
And then also the other thing that I was thinking was, especially in Randy's case, if you're pulling money from the Roth to buy a piece of property, when the kids inherit the property, they're going to get a step up in basis to the fair market value at the date of when you and your wife pass away, or when the second person passes away. So they'll be able to sell that with very little taxable gain, hopefully, which basically creates another situation where
it's like a Roth.
It's a physical Roth.
Right.
I mean, of course, there is some potential if they wait and they sell it for more than what the fair market value is. There might be some taxable gain there, but that's going to be limited compared to what your $1 million plus traditional IRAs are going to be to them. So I would say you're just kind of moving from one bucket to the other, but you might be able to retain a little bit more of that Roth money for yourselves to continue to moderate your tax bracket over time if you play the brackets a little bit now too.
We hope he gave you some confirmation on that.
Thanks, Randy.
Yeah, that sounds good. That's what I needed to know. Thank you very much.
You're welcome. Have a great day.
And you know what? Because Randy had a tax bracket, essentially what came down to a tax question, we got a fantastic text message over the break, and I was able to do the numbers on it. So let's get to it.
And our texter writes, I'm 70. I'm starting to take Social Security, $5,000 a month, but still work part-time. My wife will be 69 this year, retired, and will start her Social Security in late 2027. I have 2 years of stock option exercises that will result in about $167,000 in income for the year. With investment income, we make too much to contribute to a Roth. Right now, I have $1.8 million in a traditional IRA, $40,000 in a Roth IRA, and $61,000 in a beneficiary IRA currently taking required minimum distributions from. She has $1.4 million in traditional IRA and $140,000 in Roth IRA assets. Does it make sense to contribute to a traditional IRA since there is no income cap on that? I expect my non-investment income to be around $12,000 for this year, which all go to the traditional IRA for both of us.
So,
well, actually, absolutely yes, and I would say I'd try to maximize that.
So I agree. Well, it sounds like the 12,000 might be the most that he can put in because of earned income. You can only put in as much as you've earned. But I did the math a little bit on this, and obviously we have not full information. So Texter, please take and everyone, please take this with, you want to incorporate all of your numbers. So I took the $5,000 for this year of Social Security income over 12 months. That gives us about $60,000. However, only $51,000 of that is going to be taxable to our Texter because that's 85%. Then we've got that $167,000 of additional income that'll be coming in, brings us to $218,000. Plus, we're going to have to add in an unknown number of beneficiary IRA distribution because that's coming in as well that he mentioned, but we didn't get the dollar amount on that. If I add $12,000 to that, which is that additional taxable income from wages, we're over $218,000 of income. I looked at the tax brackets just for confirmation. The 24% bracket runs from $211,000, $211,400 to be specific, all the way up to $400,000. So you may be able to get those last dollars, the $7,000 over the $211,000 plus whatever beneficiary that we didn't see there, that income. You may be able to get that back into the 22% bracket by making the IRA contribution.
Yeah, I was also thinking about what's the Medicare Part B IRMA?
That's over. It's like over 216,000. It's over 218. They're right at the cusp. So I think they should make it.
Absolutely. It's going to say, because with IRMA, it's going to cost you an extra. It could be as much as $500 a month each. That could cost you $12,000 more just by going over that number.
So I agree. You might. So because we're a little short on all of your income data, you may be too far into the 24% bracket to bump us back down into the 22, but you do have the opportunity, it sounds like, to get yourself below that IRMA, which is the income-related Medicare adjustment, by making as much of the IRA contribution as you can. So if it's only $12,000 because that's all you earned, we say go for it.
And then what about the spousal?
Well, that would incorporate the spousal because, $12,000 total. If we separate $8,600 per person, they could go up to, that's $17,200, but they don't have, it doesn't sound like they have quite that earned income to get there since his wife's retired. So we say yes, make the Now, this would be a little bit different if we weren't right on the cusp, because I would say if you were not right on that IRMA cusp, that you might just want to take the money home in cash, put it in the savings account, because you're so far, you're so stacked. You're in no man's land in that 24% bracket, so it's not really going to be all of that much of assistance to you. And also, why put it back in the IRA just to have to start taking it back right out again?
And I think it's important to note here is that it's only that amount of income that takes you over the bracket that's subject to 24%.
Right.
It's not the whole. It's not your whole amount.
Great point, Dad. The tax system is progressive. Now, some people might think of it as punitive as well, but it is progressive in the sense that as you move through the brackets, the next dollar moves into the next bracket, meaning if you earn over $100,000, let's say the first $89,000 to $90,000 is in the 12% bracket. The last $10,000 bumps up into the next bracket. So you don't have to, just because you moved into the next bracket does not make every previous dollar taxable in the next bracket, and the next bracket happens to be the 22% bracket.
So many people make that mistake of thinking that just because they landed in the 22% or 24% or whatever tax bracket, that all the income that they made that year is subject to that tax rate.
Well, and again, I would certainly, and just based on your age, I would certainly encourage you to try to maximize this if you can, because in 3 years, my boy,
got to start pulling the money.
And that's going to be, assuming you had no growth, at $1.8 million in traditional IRA, that's $54,000.
Right. Luckily, it sounds like his stock options will no longer be. He lined it up perfect. The stock options exercise over the next 2 years. He won't be 73 quite yet, and then he'll replace that income with.
And we know at that.
RMD.
And we know at that time what will happen is, if you and your wife are charitably minded, you'll then be able to reduce the taxation on those RMDs dollar for dollar based upon the charitable contributions that are made directly from your IRA.
Right.
Cool.
Awesome.
Great
question.
Good technical question. Wish we had more information.
That's right. We could be a little bit more precise. However, it does sound like to be.
We put it up on our whiteboard right now and do all the calcs for you.
And I do want to just make one quick adjustment here. I was looking at the brackets. The 12% bracket's actually been nicely adjusted for us in 2026. You can go all the way up to $100,800 in income and still stay in the 12% bracket if you're married filing jointly. So that went up from $89,000 to $100,800. Very cool.
And our next texter writes, when you guys always talk about something having X amount and savings, do you mean just cash laying around, or is that savings in a low interest bearing account?
We hope not.
So, when we talk about savings, we are talking about liquid cash. It does not have to be in your possession, though, so you don't have to have a stack of hundreds underneath the bed or in the mattress. We do recommend using easily accessible accounts, though. So money market accounts, especially online now, have become very easily accessible, which may yield you a higher interest rate. It does float, though, so you got to be careful about that, and there sometimes can be fees or requirements. But we do recommend putting it in a place where you can get the most interest possible, but it has no liquidity restrictions. Your savings account should not be subject to market risk and should not have any lockup periods, because the point is that you want easily accessible cash in the event that there's an emergency or in the event that you decide you want to spend it on something.
It also isn't unreasonable to assume that many of our clients do have after-tax investments, maybe mutual funds, maybe individual stocks, etc., that are also part of they consider it part of their savings vault. We consider it the same way, but again, we kind of differentiate between cash and near cash assets and those that are actually invested.
That's a good point.
And our next texter writes, I hear you talk a lot about emergency vaults and savings. What is the appropriate amount? Well, kind of depends on you.
I think we always talk about a good start, and that's a great point. I think a good starting point is between 5 and 10% of your liquid net worth. Or
maybe you're spending totals on a 3 or 6 month basis. Maybe have that as your starter for an emergency fund. Like, what are your expenses over 3 months? And I put that to the side as my beginning of a emergency fund.
That's a good point.
You know, it's interesting because the number is really different when you're working versus not working. When you're working, we think of an emergency fund as something where you want to have at least 3 to 6 months set aside, because if for some reason,
your job?
Or you become ill, whatever, that type of thing. But when in retirement, what we're really talking about is liquidity. If Johnny calls in the middle of the night and needs $10,000, $20,000, $30,000, $50,000, whatever, can we get at that money without having to borrow or sell something?
Sure.
Or, how do I, if I have a bad money dream, like my mother-in-law is coming over to loot my house or something, okay? How much cash do I need to have on hand so that I can basically, go back to sleep and feel comfortable in doing that? What I would tell you is anecdotally, and I only say this because
you're starting to experience it?
Well, 20 years ago, when I was in my late 40s, I felt a little different than I do today. And I can tell you that as you age, the desire for cash and the comfort of cash continues to increase, and it does it typically at an exponential rate.
I would also mention that the majority of your vault, your emergency fund, it should be at a bank that has FDIC insurance, or at a credit union. Should not be holding extensive amounts of cash in your home because it's just dangerous. What if you have a fire, a flood, a tornado?
Or the kids have the combination to the safe.
Right. What if they get into your strong box?
That could also, of course, also those things as well. Nothing wrong with having cash literally on hand, meaning in your home. So if you need easy access to it, of course. But when we're talking about your vault or your emergency fund, we're generally saying that we would like you to see it in a local bank.
Yes. So that you don't have to. And frankly, we're not talking about internet either. We're talking about really being able to go down, drive down, say, cut a check, say, give me money.
Right. That's true, or at least having your money market linked to your local bank so you can easily access it.
Yeah, just send it right back.
But I would tell you that this whole number, it may start close to 5% and inch its way up to 10%. If you're over 10%, I think you're being a little bit of a fraidy cat here. And for those clients that have excess cash amounts, what we're really talking to them about is you typically have so much cash. We're not really you don't want to invest for you. Maybe we should talk about investing for the people that you love, the people that are eventually going to inherit this money. Where would they want it? Wouldn't they want it to be growth-oriented?
Or isn't this a cool opportunity for you as the grandparents to start exposing grandchildren or other generations to investing? We've got quite a few clients that do similar things. Like, for example, they love Carnival cruises. They go with their grandchildren, so they bought some Carnival cruise stock. Get to not only do you get some benefits on the boat for having it, but something you share with the grandkids. Of course, we're looking for growth here in a lot of cases, and you want positive returns, but there is a way to do a little bit of balancing with education, too, or it's also a fun thing like, hey, Grandma and Grandpa took us on these trips, and now we have not just a memory of it, but we've got some financial backing of it, too.
That's right, or we kept grabbing their iPhone. Right?
Great stuff. Yes. You know what? Why don't we take our first break of the hour? Because when we get back, we have quite a few text questions to get to.
Don't touch that dial. We'll be right back.
This is KTRS St. Louis, the Big 550, and KTRS.com.
This is Mariah, third generation at Newsteaders Fine Jewelry. Buying an engagement ring can be intimidating. At Newsteaders, we ensure complete understanding of your purchase. We offer a choice in both lab and mine-grown diamonds and are able to work with any budget. Let our family help educate you on your choice at Big Ben and Doherty Ferry or at wowdiamonds.com.
Hi, everybody. This is Dr. Dan Lang with Carter Pet Hospital, inviting you to join me every Sunday afternoon from 2 to 3 p.m. for the Animal Advice Show on the Big 550 KTRS.
I'm Farmer Dave, and here's my good friend and owner of MasterCars Inc., Alex Rosenberger, with today's hot MasterCars Inc. deals.
Thanks, Farmer Dave. That time of year, we are very busy. That means we're selling vehicles faster than I can acquire them. We're aggressively purchasing unique, interesting, and pristine vehicles. I love to buy Corvettes, Vipers, Porsches, and the like. We buy luxury and performance vehicles daily. Got one to sell? Call us or hop on our site. Owe money on it still? No problem. We'll make the payoff and cut you an equity check. I'll buy classics and motorcycles too. We'll even buy entire car collections. I'll come to you if it's easier. We make it quick and simple. Of course, I've got great ones to sell too. All hand-picked by me, thoroughly vetted and serviced. So if you're buying or selling, give us a call or visit our site today.
So rev that motor and point your car in the direction of MasterCars Inc. and buy or sell today. 4100 Namioki Road in Granite City, or visit MasterCarsInc.com to get more details. That's MasterCarsInc.com.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at aaron@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
Temperatures are rising. Is your AC unit struggling to keep up? If you think it's time to upgrade, Viviano Heating and Cooling are ready to help. We offer equipment from top brands like Trane and include a 10-year labor warranty on all qualifying systems, meaning any future repairs are on us. So, what are you waiting for? Get a jump start on summer by calling Viviano today, 618-345-7498, or visiting us online at vivianoair.com. Trane, the most reliable name in heating and cooling around. It's hard to stop a train.
Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Aaron Lapidus.
Welcome back, everyone, to Straight Talk on Retirement and your text messages. So if you've got a thought or a question.
We are live and local, and if you have a text that you want us to read on the air and answer, 84126 for the text line.
Right, and if you'd like to hear your voice on the radio along with ours, 314-931-5877.
And with that, let's get to our next texter. And our next texter writes, first, my wife and I are happily married.
Oh, that's great.
They love to hear it, as are our children, and will be very well off with our current savings. How do I ensure what they inherit follows in total the bloodline to my children and grandchildren?
This is a fantastic question. So what you'll want to do is check if you are using beneficiary designations that name each of your children. So for you and your wife, you are each other's primary beneficiaries on your assets. Who are the contingent beneficiaries? If you have a trust account, if you have a trust, it should be outlined in the trust that you would like to maintain the bloodline for each of your children. So your grandchildren will inherit the assets your children would have intended to inherit if they were to predecease you. If you do not have a trust and you have named each child individually, you'll want to go back and check with your custodian and anywhere else that you're holding assets that have contingent beneficiaries and make sure that they are marked per stirpes. Per stirpes will ensure that, you know, if you have a child that unfortunately predeceases you, your grandchildren will inherit what that child was intended to have inherited. So if you have 3 children and unfortunately one of them passes away,
his children won't be disinherited.
Exactly. His children will receive the third of what he should have inherited. In the past, this was not a designation that was able to be made without a trust, but many of the custodians now have added this. In the past, it was called pro rata, which just means if something happens to one of the beneficiaries listed, those assets will be divided amongst the remaining beneficiaries. We don't want that to happen. We want per stirpes. So let's go back and make sure that all of that is properly designated. Or if you have a trust, you got to go back to the attorney and make sure that language is included in the trust. In most cases, that's relatively boilerplate in trusts. However, never hurts to check.
And that's something that we're doing actively now with our clients.
That is right.
Every review meeting.
Every review.
Just take a look at these beneficiary designations. Let me know that that's still the way you want things.
Did anybody get married? Did anybody have children?
Right. And also, we've made some changes over the last few years with the changes to the tax code, adding grandchildren and great-grandchildren to to IRA accounts, rather, as beneficiaries. Are we still good? Is this still how we want it divided? Because also what we've noticed is as grandparents get older, they want more and more of the assets to go to the grandchildren, maybe less to go to the kids. Not because they don't love the kids, but because, just like our texter wrote, very well off, doing well. They want to skip generations, and they like the idea of a little extra skip. So we just like to stay in line with what our clients' wishes are.
Absolutely.
Make sure the paperwork matches.
And our next texter writes, and love this question, is it better...
Ooh, they're coming in fast and furious.
Is it better to take our required minimum distribution earlier in the year and reinvest it, or wait until later? My wife has $1.4 million in her IRA, and she's 74 this year. I'm 72 and don't need to take an RMD until I'm 73.
Rob the cradle, I love that.
Yeah, so she's going to have to take about $42,000. I would certainly say that timing really is not necessarily an issue here. What you really want to do is, if you are in a situation that you need to do this, is to match the cash flow with obligations. As an example, one of the primary ones is real estate taxes. Most of our clients have their homes paid.
Especially by the time we get to 73, 74.
Right. And so in November, December, that's when they have their obligation to pay their real estate taxes.
November and December also lines up nicely with Christmas.
Exactly. So maybe what you're doing is, if you're not using a portion of that RMD as a part of your current income flow, what you might want to do is stage it out to do specific events, whether it's, I have a cruise that we're taking in June, and by the way, we have to have that deposit in March. So time it out. There's no cost to you to do this with your custodians.
Nope.
But this is a good reason to, and this is certainly something that we do each year, our beginning of the year reviews.
And absolutely, and especially if you potentially are planning to reinvest the money, it really is inconsequential in my mind when you take the RMD, because if you think about it, it's invested right now, most likely. It's inside of your IRA. You're going to take the distribution. You do have to liquidate to cash, take the distribution, move it somewhere else, either into into a brokerage account or wherever you're planning to move the money. It's going to be uninvested for a few days. The only piece that will never be invested again is the taxes. Then you can reinvest within a couple of days. So if you want to plan out, I need a little extra cash for that for a specific expense. My RMD is about
and charitables.
Right. My RMD is $42,000. I know I need $10,000 for taxes, so we can subtract that out. We can time it all to happen at the same time. 10 goes to you, some goes to taxes, the rest goes to be reinvested, and all of those things can happen simultaneously.
I want to go back to the charitables here because it's not unusual. Our clients will say, well, we don't really do that much. Okay, great. Get a piece of paper. Tell us what
you doing?
We give, maybe we're giving $300 to $500 to the church, and then we have 2 or 3 other charities that we're sending $200, $300, $400, etc. All these should be done through your custodian of your IRA.
Yes. Also, it can be done that way if you have easy access to set those things up.
Right.
But also keep in mind, if you're an individual, you get $1,000 a year to itemize. Even if you're not itemizing your tax, your other deductions, you'll get $1,000 of charitable charitable deductions if you make them in cash.
Through the Big Beautiful Bill.
Through the Big Beautiful Bill. And if you're married, it's $2,000. So if you're under the $2,000 and you don't want to go through the paperwork, you can take the deduction later. But if you're anywhere approaching those numbers, you do want to consistently have the IRA do it for you.
Yes, absolutely. Not necessarily doing something new, but doing something more tax effectively that you're doing already today.
The text line's going crazy, so we're going to take one more text, then a break, and then we'll be back to get the rest of the text before the end of the hour.
And our next texter writes, I am retired. I am 74 years old. I do, however, work part-time, and I noticed that Social Security taxes and Medicare taxes are taken out of my check, which is great. Sarcasm. But will I ever recoup any of that money? Thank you so much.
No.
I mean, you are recouping it as you speak, which means you're paying in and you're getting the benefit out. If you were working full-time and collecting Social Security and potentially your wages were higher than they had been in the past, you might have seen a slight increase to your Social Security benefit, because taking your benefit does not change potential increases, meaning if you've taken your benefit but your wages are high enough to replace one of those 10 top years, it'll be replaced, which means you might see an incremental increase in your Social Security benefit. But if that is not the case, then you're just paying into the system you were always paying into.
And you're helping your children and grandchildren have a viable Social Security benefit, which is
That's
good.
right.
And with that, I think we'll take our second break of the hour, so don't touch that dial. We're going to be back with more of your texts and our stories right after these brief messages.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
Everyone's talking about these weight loss drugs, and it's a good thing we've got Dr. Joe Molesky with us, a St. Louis native and board-certified primary care physician. The one thing we need to know is GLP-1, right? That's the magic cure.
The magic cure is these weight loss shots. They're injected once weekly. They're not like the old medications that you've seen 20, 30 years ago. These medications actually work.
And you want to start to lose weight? None better than to call STLMedWeightLoss.com and ask Dr. Joe. STLMedWeightLoss.com.
Mizzou football.
It's a rushing touchdown, and Missouri extends the lead.
KTRS AM, FM 106.1, K291CW St. Louis.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
My name is Dan Head, and I'm the new owner of Patriot Build Sunrooms. We're still a family company with a name trusted by St. Louis for sunrooms for over 40 years. We will continue to proudly serve our loyal customers with beautiful sunrooms as well as expanded offerings like outdoor fireplaces, outdoor grilling centers, and patio covers. Check out our awesome products at our Kirkwood showroom, or give us a call for a free design consultation at 314-822-3232 or online at patriotbuildsstl.com.
Now, back to Straight Talk on the Big 550 KTRS. Here are Jeff and Aaron Lapidus.
Welcome back to the show, and as a reminder, our phone lines are open. We'd love to hear from you, whether it's by call or by text, 314-931-5877 or 84126 from the rapidly exploding KTR text line.
Let's get back to those texts. Our next one writes, are precious metals, a.k.a. gold and silver, part of the vault savings you all talk about?
Should be liquid, easily accessible cash. Now, you could consider that part of maybe your outer layer of a vault, but the true purpose behind the vault, aside from avoiding volatility, which in the past precious metals weren't necessarily volatile, but over the last year they have been. Now, nobody thinks about volatility to the upside, but we do now have potential to see volatility to the downside in precious metals, which means when you go to sell those, they may not be worth what you thought, which puts a pressure on your vault, so to speak. Also, the mere fact that you have to liquidate those, you got to go take them somewhere to sell to get the cash. That doesn't make it it's not liquid or easily accessible. However, if you personally feel this is a safer investment than being in the market, then you might have your own personal additional layer of precious metals as some additional protection for yourself.
Well put.
And our next texter writes, I turned 70 in May. When should I apply for Social Security?
Now, I would absolutely recommend hopping online, ssa.gov, and applying for your Social Security benefit, because you want your benefit to begin in May. That means your first check is going to arrive in June. The earliest that you could have applied was February, because you can go 3 months prior to the month that you'd like your benefits to begin. But you are not going to receive any value for waiting past May. So you want that check to arrive in June. And
it's easy to do.
It is easy to do. You just hop online. Now, although you're applying online, the paperwork ends up with a human being, which means there is processing time involved. Now, they will backdate for you, which means, let's say our texter applies today and they haven't processed the application in time to get the check out in June. In July, you would receive 2 checks for the amount that you should have received. So your May check, your June check, and then your July check as well. But I would say let's hop on and get it taken care of, because you want that money to start coming to you.
The other thing is you're going to also want to access the form. I don't know the form number you do, babe.
Oh, that's right, for your Social Security tax withholding.
Because you can't do that online, which is really dumb.
You can't do it through the online portal. No. When you're applying, it doesn't ask you that question. Now, through your online login, they do offer an opportunity to do it after. However, what I have found from more than one client is that process takes longer than just submitting the paper form. If you would like that, you can email, go to our website, contact us button, and say, hey, I need that Social Security tax withholding form. We're happy to email it to you so you don't have to go looking for it. And you can just fax it to your local office or mail it to the local office. And usually within a month, you will see that deduction for federal taxes, if you're in Missouri or Illinois, taken out.
And the government's really good.
They want to take your money, don't worry.
When they receive that form, and Aaron made sure that we took care of that as well.
Oh, so when you went through the process, the very next check. And we also like to, even for clients that happen to also be advisors, we like to remind everyone that the first check is going to be the full gross benefit, maybe less your Medicare premium if you're on Medicare. The next check's going to have that 10% or 12% or more, depending upon what you've elected, reduction. So don't be nervous. That we're just doing what we need to do to make sure your taxes are consistent.
And don't scream.
Well, it just won't help.
Yeah, right.
No one's listening.
That's right. And Irma may become your least favorite name.
Right.
And our next texter writes, at what age do you have to begin to draw off your IRA and what percentage? How much do you have to take? Will it be taxed?
So, if you were born before January 1st of 1960, 73 is when you have to begin taking money. If you were born after January 1st, 1960, 75 is when you will have to begin.
And you can thumbnail it by thinking that you have to pull approximately 4% of the IRA balance on the December 31 of the year prior to you turning age 73 or 75, respectively.
It's a couple basis points shy of 4,
Right.
but 4 is a great guidepost for you. And yes, it is taxable, fully taxable.
As long as it's in a pre-tax account, Roth is never taxable.
Well, no
As long as you're
RMDs, but
right.
no RMDs on Roth.
And you don't have to pull money out of Roth ever.
Right. So, yes, RMDs are fully taxable unless you're donating to charity directly from your IRA. Doesn't reduce the requirement of what you must take, but it does reduce the tax nature of what you've taken.
Yes.
And our next texter writes, if I schedule a coaching session, is it with Aaron or Jeff or an associate? Currently with a well-known investment company, Fidelity. But when I ask a specific question, they tell me to check with my CPA, which I don't have. Do you give that advice?
So, to answer the first question, if you are coming in to visit as a first visit, you'll meet with me personally. No associates, not even Dad, not quite yet. So we'll sit down, we'll chat, and we do offer advice because we have to be well informed on the tax consequences and tax nature of what our plans are going to be. So when we withdraw money, we're looking at tax brackets, we're looking at income-related Medicare adjustments. We are looking at all those pieces for you. So yes, we do answer tax-related questions. However, we do not prepare taxes. And since you do not have a CPA, it sounds like you might either have a tax preparer or you are preparing yourself. That is still suitable. There's nothing in our office that we do that would create a more complicated tax situation for you. In fact, our efforts are always to simplify taxes. So that means when we're making withdrawals from accounts, we attempt to do it from one account so that way you get one 1099 and not multiple. Or we also can provide all the paperwork for you for those great qualified charitable distributions that you make. So that way when you do go to the tax preparer or you are preparing taxes, you got all the information that you need. So if you're interested, or if anyone's interested in chatting with us personally, no associates, just give our office a call, 314-863-0008. You'll chat with Kelly, our office manager, to get you set up for a day and time to come in and visit with us.
Yeah, the only thing I would add there is that we understand as professionals that there is a line between providing tax information and true tax advice, which is required to be done by a CPA. We have relationships with CPAs. If we get to a situation where it's a question, we certainly do lean on our CPAs to give us answers. But at the same time, if you have a situation that requires truly professional tax advice, we can always make a referral for you.
I think that's a good point, Dad, and we always talk about this with clients too, which is if it's a one-off question that we would like confirmation on, we'll go to our CPA and ask that question on your behalf. We don't have to get involved in billing and sending you to a CPA for a relatively quick question. But if you run into a tax situation that is more complicated, where we're going to need ongoing or additional advice or preparation, then either we'll bring the CPA in as consulting, or we'll send you off to a CPA or back to your own CPA in order to work through those things. And we're also always here to help as part of the team.
Absolutely.
And our next texter writes, I am currently working and 60 years old. I am currently working with a financial professional who is suggesting I do an in-service rollover to an IRA while still working. Is this a good idea? What are the pros and cons of this?
So,
you want me to take that one to start with?
Start with that one. I would just say the first thing is, we call that an in-service distribution, not a rollover.
Generally, I would say that an in-service distribution would only be appropriate in one situation. Just one. Which is the investment offerings that are available through your current plan are not either A, expensive,
Either they are expensive.
They are expensive, and you're looking for lower cost alternatives, or there's something that is not available through your investment options that you want to take advantage of. Otherwise, the answer is no. What happens is when you move money to an investment advisor, like the one you're working with ourselves, there's a fee involved, which is a fee for active management. We, as you know, folks, we charge 1% annually for the assets that we manage. We prefer for our clients to keep their money in their plans until they retire because it's a lower cost environment.
That's right.
We're happy to provide them with, we call it education, which is really sometimes people call it advice, but education about modeling their portfolios, options they could use, but
how much to contribute, all of those pieces.
Leave the dough there.
And also, not only is it potential increase in fees for you, it is a potential to limit your options. Now, our texter is 60 years old, so they're already eligible to make distributions from retirement accounts without penalty. But if our texter was only 50 or 55 years old, doing an in-service distribution can limit your choices because when you want to retire, if it's prior to 59 and a half, now you've limited that over 55 rule, which will allow you from 401ks to make distributions in any amount at any time, no penalty, just taxes, to a place where now we have to look at alternatives, which can limit how much and when we can take that money out because they're in IRAs now. So we prefer to have all of our options open, keeping as many doors open as possible, so that way we can be as flexible as possible as clients move towards retirement.
I would just make one other comment, and it's not meant to be negative anyway. But generally, what happens is we see that folks that are requesting these type of distributions are usually going to purchase annuity contracts.
Right, because you usually are unable to purchase annuities inside of 401ks. In fact, I don't think you can.
The answer is you can wait. I mean, that's just the truth. We never recommend it. And keep your money in the lowest cost environment. Your advisor should want you to do that because then there'll be more at the time it comes to roll it out.
Which makes their job easier and your life more comfortable.
I wish I knew the advisor's reasons for it when he was pitching it. If I could have been a fly on the wall.
Well, I mean, we could recreate it, but it doesn't put people in a great light. So let's move to our next question.
Yeah.
And our next texter writes, if I work with you and you manage my money, can I still be in Fidelity, or does it have to be transferred into who you brokerage with?
So this is an interesting question. We do the majority of our custodial work through LPL Financial, which means in most cases, yes. We would request that we work with you to transfer those funds. No taxes involved. We move everything, what's called in kind, over into new accounts with LPL Financial, which is our broker dealer. However, we also work with a registered investment advisor, private advisor group, which does give us a few other custodial opportunities. Fidelity actually happens to be one of them. However, to be in line with our investment philosophy, our modeling practices, and we would prefer that they are with LPL because that's where the majority of our funds are held for our clients.
The only other light I might shed on this is that your assets with us, your assets don't have to be custodied at Fidelity for us to access Fidelity funds, ETFs, mutual funds for you if that's a druther that you have.
Right, and that's a great point.
They have nothing that is
proprietary.
Exactly, that we don't have access to through the selling agreements through our broker dealer.
Right, and so what that means with what you're saying, Dad, in our process, we would move everything that's at Fidelity in kind into accounts at LPL Financial, which means we wouldn't even have to sell anything in order to maintain it. We would just say there are certain things that you like, you want to keep, you have emotional attachments to. We can hold those, and then we can model the balance of the assets.
And we're in a no transaction fee account, which means that we can make trades as needed, and there's no charge to you to do that.
That's right. That's great. And you know what else is great? Tuning into our show next week, 9 to 11 a.m. every Saturday morning. Or if you are looking to retire, already retired, please give our office a call, 314-863-0008, and we will see everyone next week.
If opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Be listening next week at 9 for more straight talk on retirement with your retirement coaches, Jeff and Aaron Lapidus, on the Big 550 KTRS. This is KTRS.